Good morning. Thank you for joining us. We're excited to talk to you guys today about retirement. Most people plan on saving for or want to save for retirement. Sometimes it's difficult to know where to start or what your options are. Research shows that most families do not have enough savings set aside for retirement, including those approaching retirement age. If you have started saving for retirement, that is great. This workshop can help you determine what else you may need to do to make sure you reach your retirement savings goals. Beginning to save is important. Making sure you know how much to save is important too. We'll address that topic in this workshop as well. When we create financial plans, we often assume everything will go exactly as expected. While it's possible that it will, more often than not, it doesn't. We know that life is full of surprises, both good and bad, and it's impossible to predict exactly how things will turn out. The good news is that you don't need a crystal ball to plan for your financial future. In this workshop, we'll cover some of the tools and techniques that you can use to prepare yourself for unexpected financial events, including financial emergencies. And we'll also talk about limiting the negative impact if you're already dealing with a financial emergency or facing a time of financial uncertainty. So let's look at our agenda today at some of the topics that we will cover. We will examine the factors you should consider when planning for retirement, learn how to estimate your retirement expenses, identify the saving and planning strategies that allow you to maximize your savings at any age, and compare the type of retirement plans available to you, and also setting your own goals for retirement savings. Wherever you are in your retirement planning, it's not too late to develop or refine your saving strategy. When considering retirement, there are some factors to keep in mind while deciding how much to save. How much you can save depends on your current income. Your current income includes everything you earn from your salary, tips, welfare benefits, and other sources. Think about the kind of lifestyle you want to have when you grow older. Remember, you won't be working anymore, but you will still have to pay for expenses. Think about your current expenses as well. It will help you plan for your savings goal. Make a budget so that you can better understand how and where you're spending your income. Then see if you can cut back on spending and move that money into savings instead. You can plan your budget by using the form on page 3 of your participant guide for this workshop. We won't fill it out today, but definitely use that as a tool for you when you are ready. As more and more people are living longer lives, it's important to consider medical costs. They can include the cost of prescription drugs, emergency care, surgeries, and insurance. And even in retirement, you can still be taxed. Income earned from retirement investments may put you in a higher tax bracket, and any earnings may be taxed. There are also other factors such as interest rates on savings, earnings on investments, and inflation that you should consider. Some people look forward to retirement to enjoy the things they did not have the time to do while they were working. But retirement is also a time when you are no longer earning an income, so it's important to set retirement savings goals. So let's find out more about retirement savings goals. To have financial security when you are no longer working, you need to develop and implement retirement savings plan as early as possible. So here are some questions to ask yourself when developing a retirement plan. When do you expect to retire? How long do you want your retirement to last? What is your income? How much should you save each year? A good retirement plan also allows you to plan for unforeseen expenses, deal with changes in living situations or health, and remain independent in your later years. One important factor you'll need to figure out is how much money you will need during those retirement years. So start by determining how long you will likely be retired. This estimate requires thinking about when you will likely retire and your life expectancy. You might think about how long family members typically live, or use the current national average, which is about 85 years old right now, or play it safe and estimate on the high side, say 100. These numbers are just an estimate, but a good place to start planning. Then figure out how much money you will need each year to live securely. Everybody is different, but a good rule of thumb is to aim to have at least 70% of your current income available to you each year of retirement. So for example, if you make $30,000 a year, you should try to have at least $21,000 available per year during retirement. So let's put these steps to work. In your participant guide on page 4 is a form that looks just like this here on the screen. So we've figured out step 1 and step 2, and finally step 3 is just a pretty straightforward multiplication exercise. So multiply the number of years of expected retirement by your estimated annual retirement savings to get the amount you will need to save by the time you retire. Although the exact amount you will need will be affected by any number of life factors, that calculation gives you a baseline total that you would need to save for retirement. Now, you can adjust your retirement savings goal amount or increase your monthly savings to reach your goal, but money isn't the only factor to consider. You should also consider the time of your retirement. When you are planning your retirement, one of the most important elements to understand is time. So what are some reasons that people would start saving early in life? Well, maybe saving was encouraged by their parents when they were younger, or maybe they enrolled in their company retirement program early on in their career. Maybe they just understood the value of starting early. What are some reasons that people might wait until they're older to start saving? Well, maybe they didn't understand how to start saving for retirement, or maybe they didn't think they could afford to set money aside for retirement. Maybe they weren't offered a retirement plan option through their employer, or they just chose to spend their money on other things. Maybe they just didn't know the value of starting to save early. So how can people catch up if they start saving later in life? Well, you can save more, or you can try to increase their income to have more money to set aside. So let's look at an example of one person's goal to retire at the age of 67 with at least $600,000. For instance, if this person's goal to retire at 67 with at least $600,000 saved, they would need to save much less if they started saving when they were 18 years old versus when they were 50 years old. Without factoring in the impact that compound interest would have on retirement savings, an 18-year-old would need to save approximately $245 every year to meet that goal. However, if this person waited until they were 50 years old to begin saving for retirement, this number would increase to $35,294 annually. The key thing to remember here is that the earlier you begin to save for retirement, the less you will need to save each year. Your financial situation influences when you start saving and how much you can save. So let's take a closer look. The earlier you start saving and investing, the greater the power of compounding interest will be for your financial future and the more money you will be able to save for retirement. Compound interest is basically earning interest on interest. So rather than just earning interest on the amount of money you save or the principal amount, compounding interest is interest earned on that principal amount plus the amount of accumulated interest. The more frequently interest compounds, the greater the total compounded interest and the greater your retirement savings. It's like your money doing the work for you. So let's take a closer look. Let's go back to that example that we just discussed about starting to save for retirement at 18 instead of the age of 50. So we will assume that you still have the goal to retire with at least $600,000 at the age of 67. However, in this example, the 401k you are using to save for retirement averages a 6% return. So by factoring in compound interest, the amount you would need to save each year decreases dramatically. And that's because you're earning interest on your principal amount and then earning interest on that increased number. So in an account with 6% returns, an 18-year-old would need to save $2,198 per year for 49 years rather than the $12,245 without compounded interest. And the 50-year-old would need to save $21,266 a year rather than the $35,000 without compound interest for 17 years. So you can adjust your goals or use the power of time and interest to reach your savings goals. So let's look at a scenario that'll help us understand how compound interest works over time. So in this example, Joan invests $100 into a retirement account. She then contributes $50 per month in an account that earns 10% interest compounded annually. So which chart best describes how her money will grow after 40 years? So there's a chart. This chart's also in your participant guide on page 5. A couple things to note about the charts. Chart A, or they have different x-axes. So chart A, you'll see it goes up to $300,000, and in chart B, the x-axes only go up to $30,000. So you can see that in chart A, the money is going to grow much more significantly over time. Remember that compounding interest means that you earn interest on the interest. So because of this, more money earns more money. Many people underestimate how much they can save over longer periods of time because of compounding interest. So most of your retirement income will likely come from your personal savings, retirement plans you've enrolled in, Social Security, investments, or other sources. If you aren't already saving, now is a good time to start. Many savings vehicles are available to you, and as you've learned, the power of interest and compounding interest over time means that you'll save even a small amount, or that even saving a small amount today can have a positive effect on your future financial health. You may already be enrolled in a retirement plan, such as a 401k through your employer. If your employer offers a plan and you have not signed up, I encourage you to read up on what that plan offers because it may be a good fit for you. One of the perks of an employer-sponsored plan is employer matching. Employer matching of your 401k means your employer contributes a certain amount to your retirement savings plan based on the amount of your own annual contribution. Typically, employers match a percentage of employee contributions up to a certain portion of your total salary. Now, if you don't have access to a retirement plan through your job, don't worry, because we'll take a closer look at some different retirement plan options available to you in the next section. So the Social Security Administration is a government agency that helps older and disabled Americans and their families. Social Security benefits are one of the most important sources of retirement income for many people. The amount you receive is based on your lifetime earnings. For people with average incomes, Social Security replaces about 40% of their income. You can collect Social Security benefits as early as age 62, but if you wait longer, you can collect a larger amount per month. Just like savings accounts, investments can also grow over time and add to your available income during retirement. Many people choose to invest in real estate, stocks, or bonds. Investments can be risky, but they can also be rewarding. We'll explore some ways to manage risk shortly. Your retirement income can come from other places too. Owning a home may provide a variety of ways to earn income, including renting and selling. You may also receive inheritances, gifts, or money from friends or family that can contribute to your retirement fund income. So now that you know where your retirement income could come from, let's discuss how you can build and grow those sources. Savings is an important and valuable financial habit. It's also one of the keys to growing a stable source for retirement income. First and foremost, saving for retirement involves putting aside money from what you currently earn so that you can invest it. This means you need to budget your money so that you can save a certain amount each month. It is important that you make it a habit to set aside at least a little bit of money for retirement on a regular basis. It is ideal to save part of every paycheck for retirement, but if that's not possible, put some aside monthly or several times each year. And once you have some money saved, you may decide to invest it. When you invest in things such as stocks, bonds, or real estate, you hope that they will be worth more over time than what you paid for them. This type of investment may be risky because some assets may go down in value over time. Consider how much time you have and how much risk you are willing to take. A strategy many investors use to spread out risk is called diversification. Diversification is like making sure you don't put all your eggs in one basket. And it's important to keep in mind, though, that diversification doesn't eliminate the risk of losing money. Deciding how and where to invest your money is up to you, and we cannot tell you which choice is best for your particular situation. However, lots of options are available, and we'll explore some shortly. So let's take a look at some of the most common types of retirement plans. There are several types of plans, all of which are designed to help you accomplish your long-term savings goals. Retirement accounts allow you to save money as cash or invest it in stocks, bonds, mutual funds, and other investment vehicles. Let's look at a few different types of accounts. Many employers offer tax-deferred retirement plans, such as the 401k and the 403b, which allow participants to make pre-tax contributions to an investment account. The earnings on your investments grow tax-deferred, and if you leave that job, your contributions and earnings are yours to keep. Every employer-sponsored plan is different, so research the rules for the options available to you. So the 401k is a retirement savings plan offered by an employer. With this plan, you decide on how much money you want taken out of your wages and invested. The money invested is tax-free, but any money you withdraw in retirement is taxable. It's important to remember that early withdrawals are not only taxable, but in most cases, they incur an additional penalty tax. Actual plans and details will vary based on your employer and other factors. The most well-known and valuable feature of the 401k is that some employers may choose to make a matching contribution. That means if you contribute 3%, for example, of your salary, the employer may add another 3%, bringing your total contributions to 6% of your salary per year. Therefore, it is very beneficial to match your employer's contributions. Many employers require you to work at their company for a certain amount of time before you can keep all of those matching contributions if you switch jobs. This is called vesting. Any employer contributions that are vested are yours to keep. Now, the 403b is a type of retirement fund offered to people who work at tax-exempt organizations such as schools, religious institutions, or nonprofits. It is very similar to the 401k. It generally tends to have fewer administrative costs for employers and shorter vesting schedules. So a defined benefit plan is also known as a pension, and these used to be very common. They're not quite as common as they used to be, but they would provide workers with guaranteed benefits, like a monthly income upon retirement, and typically it was calculated according to their years of service and earnings. If your company does not offer a plan, or if you're unemployed or self-employed, you can start your own individual retirement account or IRA. You can also increase your retirement savings by contributing to an IRA as well as your employer-sponsored plan. There are two main types of IRAs: traditional IRAs and Roth IRAs. In a traditional IRA, your contributions are not taxed until you withdraw the money. With a Roth IRA, you contribute after-tax income, so you may withdraw money tax-free at retirement. You can contribute to a traditional IRA until the age of 72, as long as you're earning a taxable income. With a Roth IRA, there's no age limit, and you can contribute as long as you're earning a taxable income below a certain limit. Make sure to research these limits, as they do change from year to year. For both traditional and Roth IRAs, you can contribute up to $6,000 per year. If you are age 50 or older, your contributions can be as high as $7,000 per year. Both traditional and Roth IRAs may have tax penalties for withdrawing early. However, there are exceptions, so consult a financial advisor or expert before making any decisions. There are many options to choose from, so speak with a financial planner, an accountant, or an attorney, and do more research. Talk to your friends and family while making this decision. Knowing your options is always a good place to start, but how do you choose from these options? So let's go over some factors that you may want to consider when comparing plans. If you are able to enroll in an employer-based retirement plan, such as a 401k, check to see if your employer will match your contributions and when the matching contributions will vest. Try to contribute enough to get the full employer's match. Fees. There may be several fees associated with different types of accounts, so that's something you definitely want to keep in mind and research as well. And sometimes you may want to withdraw money from a retirement account early. So you'll need to check to see if there's any penalties associated with an early withdrawal. Some plans, such as 403Bs, may allow you to withdraw money as a loan. But be careful though. Research your options thoroughly before borrowing from a retirement plan. And there's no escaping tax on your retirement income, so think about whether it makes sense to pay the taxes now or when you withdraw the money. One way to think about making the decision about the tax status of your plan, such as deciding between a traditional or a Roth IRA, is to compare your current tax bracket with the tax bracket you think you'll be in during retirement. If you expect to be in a lower tax bracket when you retire, you may choose a plan in which you pay tax on the money when you withdraw it. The reason is that if you withdraw it at a lower tax bracket, you will pay fewer taxes. So talk to a tax professional or a financial planner to find out which is the right decision for you. Most people set up a retirement plan to provide for their own future. However, many people also set one up to provide for their spouse, children, grandchildren, or charity. Knowing the purpose for your plan can help you decide which one will help you achieve your goals. Discuss this plan with a financial planner or an estate attorney, as there may be unexpected tax consequences when your loved ones inherit a retirement account from you. Retirement plans and personal savings aren't the only way to save for retirement income. Let's look at how investing outside of retirement accounts can add to that. Another way to plan for retirement is to invest directly in vehicles such as stocks and bonds, or a diversified combination of several options. You can own part of any publicly traded company's assets and earnings by purchasing stock in that company. You may often hear people refer to stocks as shares or equity. The price of a company's stock may go up and down. You can also lend money to corporations and government agencies and earn a fixed rate of interest for a specific period of time. The borrower pays you interest on the principal, which is the amount you originally invested. Bond rates are tied to interest rates. Bond prices fall as interest rates rise. You may earn a profit by selling the bond for a higher price than you paid for it. Mutual funds. So you can pool your money with that of other investors by purchasing shares of mutual funds, which are made up of any number of assets, including stocks, bonds, real estate, and cash. They vary in other ways too, such as the types and locations of companies in which they invest. Actively managed mutual funds are overseen by a fund manager, while index funds are built to match a market index. Investing may seem risky to many people, and whether you want to do so depends on your ability to tolerate that risk. Let's look at some strategies to manage risk in investments. No matter how you invest, you'll need to understand and manage risk. Often, risk is tied to reward. The investments that tend to have the highest returns also tend to have the highest level of risk. Consider stocks, for example. The value of stocks depends on many factors over which you have no control, such as company news and performance, industry performance, or economic factors such as inflation and interest rates. If you have many years until retirement, some experts suggest considering more risk and investing in financial products such as stocks or stock mutual funds. Stocks are sometimes considered riskier than bonds, but may have the potential to earn more money over time. Likewise, as you get older and you have less time until retirement, you may want to focus on lower risk investments with fixed incomes such as bonds. Either way, evaluating how much risk you're willing to take with your retirement savings is an important decision. Having a plan to save for your retirement is an important step to take. Now let's look at how you can keep your plan on track. We all favor instant gratification over long-term gains. Instant gratification means that we prefer to enjoy something now or in the present. This is also called present bias, or the tendency to choose to enjoy the present over the future. So what can we do to reduce present bias? Well, let's look at some strategies. First, knowing how much you'll need for retirement is a great first step. So now let's look at how you can create a plan to reach those goals. Setting a goal is the first step toward becoming financially secure in your golden years. We've already taken that first step in the beginning of this workshop, but you may want to review it again. Even if you think the goal may be difficult to reach, making a plan is a good sign. The more you think about and plan for the future, the easier it becomes to overcome short-term gains and present bias. You know that there are two main ways you can build a retirement income, through savings and through investments. Think about your future and select a plan that will help you achieve your financial goals. One way to commit to your retirement plan is to set up a scheduled or automated deposits into your retirement accounts or plans. Make your money work for you over the long term by putting it away on a regular basis. It's also important to know that once you get started on a retirement savings and investing program, it's not a set it and forget it type of proposition. Your savings and investments need to be continually managed over time to ensure that you are maintaining the risk and return levels that you need for a secure retirement. Review your retirement accounts and savings annually and put in place the most effective combination given where you are in life. And reflection can be a powerful motivator. Imagine who you want to be in the future and visualize the kind of life you'd like to be living during your retirement. This simple activity may help build healthier financial habits in the short term. It is important to develop and implement a strategy for planning a stable and secure retirement. So now that you have the understanding and tools to develop an effective retirement savings plan. Remember that the earlier you start saving, the better. Also, remember that you are not alone in this venture. Retirement plans and savings can help you grow your money. There are also professionals and organizations who can help you invest your money effectively and help you provide a secure retirement. Once you have a retirement plan effectively in place, you can start looking forward to those years of rest and relaxation. So before we conclude today, I want to take a moment to let you all know or possibly remind you about a division we have here at Neighborhood Credit Union called North Texas Capital Advisors. So our advisors, Ron and Carl at NTCA, they focus on investment management and retirement planning for individuals and their families. So I want to give you their contact information. I'm going to tell you, we're also going to post it in the chat here. But I encourage you all to reach out to them. There's no obligation to sit down and talk with them. But their phone number is 972-587-3777, or you can visit their website at northtexascapital.com. Okay, so that concludes our webinar today. Thank you so much for joining us. Now, if you guys have any questions,